at 12:30. But as soon as he gets on his feet, Hammond, and talks for that hour, and he talks about house builders, which I think is going to be his number one ploy. If there's penalties for land bank, the big houses are going to suffer. If there is incentivization for the smaller guys, you might find the smaller house builders, and I'll talk about one specifically later on, will benefit. So that's a huge one. The other one is retailers. Now, one of the other changes which is projected is a 3.9% tax, which is due to start in April, based on business rates. Now, as a correlation to my background's retailing, the large organisations with large footage stores normally has a ratio of about 1 in 10. So if you're spending 500k on rates, it's 5 million on rent. And the problem is most of these stores are not freehold anymore. The smaller retailers, which is obviously the likes of Majeski Wines, I'm highlighting that because I'm going to talk about it later, Conviviality Retailing, both of them have had tremendous surges in the last year and 2 years. Well, they work on a 1 in 5 ratio. So that 3.9% will have a much better impact if it's delayed on their profitability. And both those organisations are growing, and I'll talk about those slightly later on. Just another on a side note, factory orders has been said that they're the largest in the last 3 decades on a monthly increase. So although the pound has strengthened of late, we've still got reasonable performance. Hence, as Zach highlighted yesterday, the likes of SIG, which is building and insulation products primarily exported to Europe. If you are looking at that sector, although the forward confidence is still slightly lower than what it should be, and they're not going to hit the 1 trillion target of which they predicted in the budget for 2020. They're going to hit about 600 billion this year. You still got pockets of strength like SIG. In terms of the 3 stocks I wanted to cover with finals being announced this morning, I'll just move on to these, Zach, now. I'm going to start with Sage. Sage, huge software company, 53% of the payrolls in the UK are done by Sage. Their CEO, a guy called Stephen Kelly, who's been on Call London in the past, but he was on CNBC this morning. I'm sure he'll be on Bloomberg later. I thought they were great results, but the initial market reaction is they're down 2.1%, which is quite surprising. What they've had is an increase in their profits to 475 million. Organic growth was 6.6, although profit growth on sales, profit growth was 10.3%. What was strong was their margin went up from 27%, 27.1 to 28%, and their revenue was strong. They've increased their final dividend, and their overall dividend for the year is up 9%. So I thought those were great figures, but unfortunately the market, I don't know what you're going to do with the market sometimes, is 2.1%. But what you might have there is a reversal like what Kingfisher was yesterday. That stock is currently down. It might be one to watch, but if it drops any further, it's a buying opportunity, because it's no way it's going to stay at that level with such strong results. And Sage is an organisation, because of the reliance on the payroll software, they did 2 acquisitions last year and they've gone into other countries. I see that as a growth, but it's only up 12, but prior to this morning, 12.89% year to date. But it's got quite a good broker review. Out of 16 brokerages, 14 of them are either hold or buy. So, I think Sage is quite an interesting one to look at.
Thomas, it's a buy and hold stock, isn't it, though? It's not a trading stock, is it?
No, it's not. But I think in reality, I treat the market in 3 or 4 different ways. And, opportunity and trading is one. I did it with a couple of stocks yesterday, in and out and gone. Some of them are recovery stocks, which can be painful, or they can have great rewards. And then sector watches, like miners were last year, house builders are this year, and retailers are a disaster. And then you've got the other ones, which are the bellwethers. And if you want a bellwether, I prefer going to China, but some people would go to the likes of the lovely Marks and Spencers and BT, which are performing so strong at the moment. Marks is now at 298, unbelievable. you know, and BT is at 245. But it's individuals' interpretation, you know, and unless there's a big news like Vodafone last week, they just don't move forward at pace. But if you want to have as a safe one with a decent dividend, which some people do, but you should spread your portfolio. Right, Thomas Cook. Yesterday went up 4%. This morning they haven't opened yet. They're still in auction, which is interesting. The forward guidance is very, very strong. Year to date, they're up 69%. Again, more buys than sells in terms of the brokerages. Their sales were up 9%. Their margin was down, though. That must have been promotional activity. They reckon that they get in. Well, they reckon they're getting more business out of Egypt. I thought Egypt was one of the places you avoided terrorism, but obviously they reckon they got the Canaries at very strong and Egypt at thing. What was interesting in their results is their net debt has dropped dramatically, down 122 million when you look at their reports, and they're down to 40 million. They're paying a dividend of 0.6p. I think Thomas Cook is massively impacted by geopolitical. Personally, I would avoid it, but I wanted to highlight it because Sage and Thomas Cook are the two largest companies in terms of customer interest reporting today. The third one, which
just to say, I mean, Thomas Cook's been one of the most remarkable recoveries of recent months, and starting really with that gap through the 200-day average in November last year. So, would that be the type of stock you'd regard as a recovery situation, or was it too flaky for you?
I think the geopolitical problems with the number of ISIS kind of related incidents which we've had around Europe would always make me refrain from going into it. That's my own personal opinion. However, there is probably a further upside, and obviously today's results have reflected that. But I don't know what it's going to do when it does open. We're still online, I would have thought, but at the moment they're in auction. I think there is further upside. That's why I brought it up as well. Yeah, but okay, you know, for me, there's such a choice in the market. I just wouldn't bother, but someone else might. Yeah. Countryside properties. I think that the building industry is under a lot of pressure. This is obviously a more upmarket, smaller operator. They've come up with fantastic results today. 47.95% up for the year. Now, in terms of the share price this morning, there's no movement showing on my screen at all. As I say, they are a smaller operator, but they've come in with sorry, I'm just looking at the wrong part. They've come in with an increase of 28% improvement on completions.
So what's the ticker code there, Ron?
CSP.
I thought so.
CSP.
They wouldn't be doing so
bad. Their gross profits are up 48%, which is brilliant. If you take adjusted profit, they're still up 34%. They're paying a dividend, which is up 147%. So I'm not sure if they're in bloody. And then we have a look if they're in auction, because that's just a phenomenal. That's a phenomenal set of results. You would expect a market reaction to it, and yet, well, there's nothing moved on it this morning. So I don't know if that means it's just.
That's the wonders of the London Stock Exchange, you know.
Well, it's 48, as I say, 48% up for the year. You've got a share price closure on yesterday of 339. Completions up 28, as I say. They're mainly in the southeast, but they have got some small pockets in the northwest, obviously to offset the London thing. Their average selling home price is 430, so they're not a Persimmon, and they're not a Taylor Wimpey or a Barrett, but neither are they reliant totally on London with larger things like Berkeley Homes. So it's interesting that stock there, that may benefit because it's a smaller organisation, and that may benefit from the budget again today, plus with their results. But again, you make a choice if you think the house builders will continue. So those are the three winners in terms of, well, three stocks come out as finals today. In terms of interims, there was two smaller companies which have come up with interims this morning. First one, very briefly, Charles Stanley Investments. Some of you will be aware, 384. But the reason I've looked at it is because the share price has gone up 47% for the year, which is absolutely massive. You know, again, they haven't moved this morning, so I'm not sure what the reason is for this on people recording this morning, but their profits have gone up 53%. They are smaller numbers at 6.9 million. Their dividend last year at interim stage was 1.5p, but it's gone up to 2.5p, which is on a percentage basis a massive increase. And the overall buy, supported by the likes of the IC Chronicle, only Vetter's Chronicle on the 12th of October. So that I would prefer that kind of stock, Zach, going back to comparing with Thomas Cook, because it's got a 47% gain, although it's 69 with Thomas Cook. That's not going to be impacted by the likes of another ISIS attack. I may be being a bit pessimistic there, but I think it's more realistic in my point of view. The other small company is Biffa. When I used to work in retail, Biffa were bloody awful, never turned up. But they've had a major change in their management. They've done some acquisitions. The share price is up 44.24 for the year. Their revenue was up 7.8% in the first half. Profits up 9.3%. So again, it's a smaller organisation, but it's not a bad shot there, Zach, and it's going up. Yeah.
It looks very nice indeed. So is that your? So what's your? I mean, as far as the trading for this first half of the day ahead of the budget.
The one I would trade is Majestic Wine, and the reason I say Majestic Wine, if you can pull up Majestic Wine, based on what I said earlier, I'm going to be buying Majestic Wine this morning before the budget. They're up 32% for the year, up 4% yesterday. There's one thing that we all tend to still do is drink more and more alcohol. They've had management changes, etc. If he doesn't do the 3.9% in April, they will benefit. And I think when their results come out tomorrow, and that's why I'm saying today in advance, I think they're going to be strong. And I think we'll see that move with the market tomorrow. So getting in today is obviously what you need to do before the budget. So then you have a double win. You could have, if the tax goes ahead, it's built into the price anyway. If the tax doesn't go ahead, you're going to have the double win of the results tomorrow, plus Majestic Wines benefit from the budget. So that's my play for the day, is Majestic Wine. Yeah?
Right. Just run me through that rate. Was it business rates at 3.9%? What's the idea behind that, apart from publishing the highest reading?
It's straightforward. If you think about it, it's an unbalanced playing field. We've got, the Death Star, Amazon, which comes over the horizon, eats up everyone's cake. It doesn't have any kind of base costs, doesn't have any tax to pay in reality, because it's all offshore. So the retailers, the large retailers, already suffered, the likes of Comet. The others are under massive strain with their pressures. Now, one of the biggest aspects, which are fixed costs. So obviously, if you are a retailer, you've either got rates, rents, staff costs, or your stock. Now, if you're a retailer on the high street, you've got to keep your stock in the store. You've got to pay your rates, you've got to pay your staff. So there's been a lot of pressure from the retailer organisations to reduce business rates. And despite, when you look at the retailer section, and most of the shorts of a large significance on the London market, if you look at short trackers, for instance, are retailers. And it's the same in America. So answering your question, look at Signet yesterday in the USA. It was the number one shortage stock, admittedly. Came in with a slight miss in its third quarter results, fell by 30% on the day. Macy's were down again yesterday on the day. When you look at the UK, Ocado Group, which is different, but they're still the highest shortage stock, but Debenhams, Morrison's, M&S, Sainsbury's, all over 10% as a short figure. So when you look at the smaller organisations, which will benefit greater if they don't keep on ratcheting up taxes, business rate taxes. They tend to forget about the rent, but business rate taxes still, for a smaller organisation, is a massive fixed cost. So
isn't there an easy solution, Russell, that there should just be for all online retailers, they have to charge or pay a 10% tax. You know, an on-right. You know, you're on.
I'm just amazed that Trump has stayed away from this one. I think he stayed away from it because of the bigger issues, which is obviously the wall, which is not talked about that much now these days. But you know, bearing in mind that but migration into the States has dropped by 87% this year.
Because there's an invisible wall.
There's an invisible wall he's created by his
By just saying there's going to be a wall.
People coming in. It's exactly the same, which is the problem with the house builders and the euro in the UK, because who the hell wants to come here, share a 2x2 with 3 other guys, and send their money back to Bulgaria or whatever when the euro's so strong? But going into the business tax and what you said about Amazon, Trump was going to tax Amazon more fairly in the States, but because so many jobs are being lost through retail out there, so many out-of-town centres are closing down. It's a much more acute problem than what we got in the UK, even though the UK costs are higher because of the shortage of land.
Yeah, but it could easily be an online business rate. You just say, for anybody setting up shop online, they've got to pay the equivalent of the business rate.
Unless they do something, Amazon will destroy retail, as we see it, quicker than anything linked to automated checkouts. We've got to bear in mind that 1 in 6 youngsters under the age of 25 work, 1 in 6 people work in retail. Retail employs 2.77 million people. Tesco's is alone got 327,000 people. Now, they keep on retaining their margins down because of the likes of the Aldi and the Lidls, but they can't carry on forever. You know, the situation is, you know, when you look at the demise of Carillion and Balfour Beatty, we tend to go for everything cheap in the UK and not pricing it accordingly. People don't like the idea of paying what you get, but until we actually pay more money for things, which people say we can't afford, but obviously once you've gone through a cycle of 1 or 2 years, people become more stabilised. You know, people criticise the banks for making a profit. Without them making a profit, we're stuffed. So, you know, the circumstances are, I can't see anyone hitting Amazon. Now, and Europe may be the ones which will hit them first because they've gone after the likes of Alibaba. Not Alibaba, sorry, Google, Alphabet. But Amazon are going to kill retail. Simple as that.
Okay, we'll just go on to the stocks of the day, which rather interestingly, one of the ones you mentioned today, or a couple of them are there actually on the downside. Thomas Cook down 12%, according to my figures here, and Charles Stanley down nearly 9%. Does that offer a buying opportunity for you?
Charles Stanley, I think it does. Thomas Cook, as I've talked about earlier, I wouldn't. Yeah. But Charles Stanley's profits were good.
Yeah. Okay. And then on the other side, Kinetic Group, which for my mind was a bit of an M&A play, but we'll have to find out what the reason for the move there is. And Carillion actually bouncing back after a horrible day yesterday, back around the 20p level. But 20 pence.
When you trade Carillion, from an experience which obviously I've had on buying and selling it, there's so little liquidity in terms of selling that stock that as soon as it goes up or down, if you want to get rid of a position or get it, you just can't do it.
There's a lobster pot.
Basically, there's not a lot of liquidity left in the market with it. You know, there's a massive short community still out there. They're still the largest shorted stock on the London stock market. I think people are just waiting for it to go down. With the rights issue, well, obviously the current price, the rights issue is going to have to be almost like a long min. But I think the government will bail it out indirectly in the end because there's 20,000 people in the UK employed in that sector. They can't afford to lose the NHS contracts, the rail contracts, the building of schools. There's just too much there to allow it to go through, but it's going to have no value for shareholders. No value at all. I've looked at to my misery. Yeah.
But shouldn't it be the case that somebody should investigate why such an unstable company has been getting so much business?
Yes, because they manufactured the contracts in terms of forward charging their profits from the Far East. They took that charge of over 800 million in the Far East. They're owed, people don't realise, they're owed over 800 million outstanding payments because they've defaulted on jobs, on the accuracy of their work. But Qatar alone owe them 200 million. Hence the last trading update they did before the bad news on the Friday, which was on the Thursday, the Omar 240 million contract. They even said in the RNS that it was being forward paid by all costs because it was taking away the concern of cash flow. But they've got cash flow now because they've delayed their payments on their pensions and their debtors until 2019. But that's at a cost because obviously running with a debt of almost a billion, it's 900 odd million currently, and they're paying 12% above LIBOR. So it's going to cost them 120 million to actually stay still, to pay the debt on a future basis, only by raising revenue, when they reckon the last 5 years there was no real profits because they were masqueraded by revenue and profits from the Far East, which has been withheld. Now, you know, I took the gamble, but I wouldn't do it again.
Okay, well, what could possibly go wrong at 12% above base? The other stock, just the other move there, Kinetic. Just have a look at the chart there. It looks like it's been upgraded, and that's why it's from buy to hold. So there's a bit of a bounce there off the lows, but has been a rather miserable situation. Nice divergence there, I suppose, ahead of this bounce, but still, this stock has been tended to be a sell into strength up to this point. Russell Jones, thank you for your extended coverage today. Really enjoyable. Hope to see you and hear you back on the show tomorrow.
Will do. Look after yourself.
Cheers. Simon, are you available?
Thank you. Yeah, we're going to jump straight to Carol, who's been waiting patiently. Carol Harmer is waiting in the room to come and give us an update on the charts, the Forex markets. Carol, good morning. Sorry to keep you waiting.
That's okay, Simon. Morning.
Great. Good to have you here. Shall we transfer to your screens?
Sorry, I didn't quite catch that.
Shall we do we'll do the screen share if that's okay with you, so we can see your charts. You should be able
Simon. Right, you disappeared, and I thought after waiting for 40 minutes, it was
okay.
quite annoying that you disappeared.
Okay.
I'm sure you enjoyed it anyway.
I'm not really into individual stocks, I'm afraid.
Okay, so what are we looking at this morning? We're looking at we're going from the fundamentals to trading now, and we are
well, not so much fundamentals. Right, am I ready to go, or what?
Yeah,
we're ready. You're all ready to go.
Okay. Right, into trading. Right, the euro dollar. You can see we've had this good move up. Now, the move down has only been correctionary. I don't see any reason why the dollar isn't going to continue the same trend as what it's done all year. It is a case of currency strength and dollar weakness. You're seeing that across everything, across gold, across oil. All the dollar-based instruments are all looking the same as what they've been doing all year. We've seen, obviously, corrective pressure in the euro down from 121 down to just above the 1550 area. We've had a good move back, and I can't see any reason why we can't go and revisit those 121 highs by the end of the year. Now, one of the reasons for doing that is that markets do like to return to yearly highs and yearly lows. Now, the chance of us going down to 103, I think, is pretty remote before the 18th of December. So we've got to look at the top side. Markets do like to go back and have a look at those yearly levels. We saw that with the FTSE up around the 76 area. We've seen it quite a bit coming through this year. And towards the end of the year, that's when, you know, traders get excited. They square their books around the 18th of the month, and we go through to year end. So, and the chart pattern also is showing that the market's going to go higher. If you look at all this little line of support, let me get that on a bigger chart for you. Right, if we look at this line of support here around about the 1700, 1680 area, anything down to here, I think on the euro dollar is going to be a buy. We've come off those extreme overbought levels that we saw just up over the 85% area here. So we're back to neutral really, and with this combined bullish chart pattern, which it is, you've got like a little bullish flag here, there's your flagpole, there's your pullback, no reason why we can't go up. First stop will be up here around the 1880 area, and then no reason why we can't break above there and go back and see 120 first, then 121. Even the short-term charts are still showing, you know, that we're going to go higher. And I think for the moment, all we do is buy into weakness. As I said, down to that 1700, 1680 support. I think that's like a good enough area to go long, and you're going to get a lot of protective stops, and they're going to be below 1650. So all the time we held above there, you know, we're going in for buying the euro and sterling.
Is the risk here, Carol, that is there a risk here that actually the euro will start running away to the upside and not really give people a chance, or they'll feel they're buying, you know, they won't get anything under 17?
Well, at the end of the day, you're gonna know, aren't you? Because you've got this. If I just draw this little thing in here, okay, this is your break point on the top side. You can see where I've drawn that little trend line. So you're going to have an either-or scenario. You're either going to be able to buy it down to 1700, or you're going to buy this break here.
Yeah. That's useful.
Get that up there. Can you see that?
Yeah, I can see it.
You know,
it's like a triangle. It'll be a triangle breaker.
Yeah, you've got the 200-day moving average coming in at exactly that level as well. So you're going to get two bites of the cherry, really. You're either going to buy it on dips, or you're going to buy it on a break. Whatever way, you still want to be buying currencies, all currencies, you know, across the board. You can see, we know that there are market correlations. We've seen the dollar CAD come down, you know, significantly, and that will time obviously with rising oil prices. Oil's looking quite sexy. Do you want me to go and have a look at the oil chart?
That'd be useful.
Well, it is if you're trading currencies or dollar CAD, yeah. But it just gives you an idea. You know, this is where you saw the 2016 lows down around that 26 area. Now, the first stop you can see on oil is up here, okay, around about 61, 62. You can see that, and now that will make a huge break if we do break this area, because you've got to have this base pattern here. Now, something that takes 2 years to form is quite a significant base pattern. And although we haven't seen much in 2017 of the market breaking up, I think now's the time it's going to. And as soon as we can break above that 62, 63 area, this is not a Brent, it's on the WTI, then you can see that, you know, there is nothing really to hold it for another 20 bucks. You know, maybe even more, which does show underlying, one, the strength in oil, but two, the dollar weakness. The dollar isn't strong. You've got gold prices rising, you know. Stock markets are going, well, the US ones are looking higher, but I agree with the previous speaker. I think it's all to do with the tax reform. And I think as soon as that comes out, that, you know, maybe that's not going to happen, stock markets are not going to be much long for this world. And even the FTSE is still depressed. All right, we've risen from 73.60, but we're not making any real headway on the top side. We are still looking not great. So it's all tying together, really.
Right.
Cable,
so oil could be the. Go on.
Cable is another one that's looking quite sexy. You know, anything down to 131.80. Well, 132, 131.80, you're going to see buyers coming in. It really has had an extraordinary year. I mean, if we look at this monthly chart from where we were, you know, at the end of last year to where we are now, it's been quite phenomenal. But you can see it's not, we haven't even recovered slightly what the move down that we've had from 2014. I mean, we was above 170 then. We went all the way down to 119.5. So really at 132, well, I think we've been, you know, a little bit higher, but even there, we're not showing the potential of where sterling can go. Now against the euro, it's all different because it's quite weak against the euro, but against the dollar, it's looking quite good, and it's a good currency, I think, to go into.
So you think it's still at bargain basement levels, effectively?
I do. Yeah.
Okay. Well,
I can't see any reason why you would want to sell sterling at the moment. There is, you know, above 130, you just want to be buying it.
okay. Well, that was. I mean, it doesn't even seem to want to go below 130 anyway. It's sort of the 130.50, 130.80, I think, was the lows of the recent past.
Absolutely. So, yeah, you can see. I mean, it's got a lot of natural support under there. Buyers, traders are coming in, and they are buying any weakness. And you can see by the way it's pushed up, you know, quite quickly. So it's bounding really well, and that shows me that you've got underlying strength in the market. I mean, I thought this all year. I couldn't see any reason why sterling was down below 120. I really couldn't. Not that I'm a fundamentalist, but I don't think the UK looks that bad, really. I mean, I live in southern Spain, so I'm not, you know, I'm not there.
That may be why. But we got the prime minister's the prime minister's a bit dodgy. I think that's the problem, really.
Yes. She's very.
So she makes things look worse than they are, I think.
Well, I think every time she opens her mouth, really. But they're still buying sterling, even without her, you know, even with her, without her help. Yeah. So, you know, if she shut up, maybe it could go a lot higher.
Right. Any other markets that catch your eye, or are those your sort of the favourites at the moment?
No, Aussie. I like the Aussie. Let's have a look at Oz. Now, I'm going to do that on a daily chart. You know, I think you could actually say it's the same. You can see where all these patterns and the way the price is going, you can see that they're all sort of tying in with a weaker dollar. I can't see any reason why the Aussie can't go up, and I think as long as it stays above 75, we could break that 76 area and go back up to here, which would be around the 77 and a half. I think that's a good area to get short of, or at least cover your long position in the Aussie. But to be honest, I like all currencies at the moment. I think they're looking quite sexy.
So you're pushing on an open door against the dollar, in other words.
I am, yes. I am. I don't know why the dollar yen's down here. I think that's just a, you know, weakness in the dollar. Because normally the S&P and the dollar yen go the same way. You know, you've got that risk on, risk off scenario. I just think the currencies are the better play at the moment for them to go higher.
And that also helps if you're squeamish about where the indices are, isn't it? I mean, that's the other thing, that the indices feel very high.
They do. The indices do feel high. Oh, mind you, the NAS, I mean, it doesn't seem to be any stopping that little love. It just keeps making new highs, bless it. Even the Dow's recovered. So, you know, I do think this dollar, I've heard in the last few months, you know, people are saying, well, the dollar's changing, the dollar's turning. I haven't seen that at all. I haven't seen that in the dollar index. I haven't seen that in the outright currencies. I haven't seen that if anything, the dollar index looks really, really weak to me, and I can see that back below 90 quite quickly. You know, but don't forget the major currency in that index is the euro, which would tie in with my I think we ought to buy a euro scenario.
I mean, it sounds a bit brave, obviously, given the German situation, but I suppose that's the wall of worry that people are climbing. I mean, it's caught people out, hasn't it?
Well, the thing is, I don't look at fundamentals at all, not in 35 years. There's too many variables of them. They can be interpreted, you know, you get a panel of economists, 10 of them, and a figure comes out odd, but they'll all interpret it in different ways. There's no misinterpretation with the chart. It's there. And if the charts look bullish, you're going to find the more buyers than sellers. That is just the way it is. It's not changed. Yes, we've evolved over 35 years, but the basics of trading hasn't altered. And I don't think really there is that lean to the troubles in Germany thing. I don't think that affects your average trader anymore. It just doesn't. They just look at it and go, do you know what? It's gonna it's above here, it's going to go higher. And it does, over the years, that has surprised me. It has, I can't believe that it keeps happening, but it does. So, you know.
Isn't that just like financial journalists trying to pin a story to the price action, which has got nothing to do with what's going on at all? And
absolutely, and I found that in my whole work experience, there's always somebody that wants to give a reason. You know, more bid than not isn't a good enough reason to buy the euro. Do you know what I mean? It doesn't sell newspapers, it doesn't make financial journalists. But that's basically what it is. There's more buyers than sellers, you know, and that is reflected in the price action. Yes, we look at the indicators and we look at other things. You know, the psychology of the market, what the trend has been, what the patterns are evolving, There's all sorts of things that you can look at, but at the end of the day, you're just looking at price action. And if these patterns form, which you can see quite clearly on the euro dollar, it's forming. When these patterns form, you're naive, if you like, to go against what the rest of the world is seeing, because there is no misinterpretation of the chart, whereas there are misinterpretation of fundamental data.
Yeah, I mean, the other thing is, I suppose,
when I worked at the banks, we couldn't get 4 economists to agree what the figures were. So, you know, worldwide economists, and I've never met an economist that can actually trade a currency market. I've tried looking for one, but I personally have never found one. So I think they're better off sort of doing their little analysis on fundamental data and leaving traders to trade it. And we're quite basic, really. We're quite simple people, and we do look for, you know, we're all in it to make money. We're not in it to be the greatest economist of all time. We're in it to, like, do you know what, if it goes to here, you buy it because it's going to go to there. That's my job done. Happy days.
Just the other final point, Carol, with the euro potentially heading back towards 120, would you then be a seller of the DAX on that relationship? That's the normal relationship we have.
Well, I'd be a seller of DAX anyway if I traded the DAX, which I don't, because it's, you know, something that's made up of. It's very manipulated, I find, the DAX, and it can just move so quickly on nothing. But yeah, I mean, anything towards 130, 113.30, I would be looking to sell if I was selling it. I'd be more looking to sell the FTSE up at 75, 74, 75, 7,500. But if that DAX if the FTSE does get up there and the DAX is anywhere near 13,300, sell it.
Okay, well, thank you very much, Carol. Thank you also for your patience in sitting through Russell Jones for 40 minutes.
No worries.
Thank you.
Thank you, Carol.
Okay,
Speak to you soon. Take care.
Yeah, ta-da.
Okay, Zach, we're just again, we're just going to go straight over to John Adamson at sharetop.com for his stock of the day, and that'll take us up to 9 o'clock. Passing the presenter role back from you and bringing John in again. John, sorry to keep you waiting a little longer than planned, but good morning to you.
Good morning, Simon.
Great.
Hi, John, how you doing?
Morning.
How are we doing?
We're fine. We are looking at THR.
Thor Mining PLC, yes. I'm not seeing it quite yet. There we go.
Beautiful.
Beautiful, yeah. It's quite a nice looking chart there. So Thor Mining PLC, it's an Aussie miner, dual listed on ASX and AIM. They essentially got a number of assets. The sort of core primary asset being the tungsten project in Nevada, which is Pilot Mountain. They've also got a sort of legacy core asset in their Molly Hill asset in Australia, and they've recently bought into a copper project in Kapunda and are currently doing due diligence on a gold play in the Pilbara region of Australia, which we all know to be highly prospective, as has been discovered by the likes of Kairos Minerals and Artemis and Novo as recently as the last few weeks. So yesterday, Thor Mining had news out. Sorry, just bring it up. They had news out about. Why has it just lost my mind? Sorry, my mind has gone completely blank. So when they took over the Pilot Mountain project back in 2014, they had an outstanding liability with the project owner of 1.13 million. They've actually paid that off as of yesterday, as announced to the market yesterday, for the sum of 95k, which represents about 8.3% of value. That is really pushing that project towards production significantly by getting that debt out of the way. And this is kind of in line with Thor's general approach at the moment, which is pushing all three of those projects through to commercialization in a very sort of swift fashion. Last week, they announced that with recent exercising of warrants and the most recent placing, they've raised 1.3 million in the first couple of weeks of November alone. That's all cash in the bank. They've raised 125 grand from the exercise of options of one of their directors, and that money is being used specifically, as requested by the director, is being used specifically to investigate projects in the Pilbara region. So the Pilbara region of Australia is, we mentioned this with Greatland Gold last week. They've actually got a cobalt play, which could be prospective for gold, but it's had a number of significant gold discoveries recently. So Thor are actively on the lookout for a gold project that could have very near-term production potential in the Pilbara region. We expect to hear how that due diligence has gone probably by the end of the year. And then I think there's the reason I'm talking about Thor today, even though we've not had news out this morning. You're looking at the chart, Zach, there, and you can see that this is a company on the rise. And where we're at with the news flow at the moment is, I think a lot of people seem to have picked up on that the copper project they've got in Australia, that's due a JORC compliant resource estimate by the end of December. It's also due government grants, notices to help fund that project, and there will also be water sampling results coming out from that particular project. The tungsten project in Nevada is the biggest tungsten, it's the largest tungsten resource available in America that we know. Trump has his ideals on large infrastructure projects, tungsten being one of the most common components of steel. So it's a highly sought after commodity, and it's also rising in price. So I think this has got a long way to go. Yes, it's done very well. You could have got in at 0.9 pence as early ago as mid-October. So we're around the sort of 2.2 pence mark at the moment. Yes, it's done very well, but I think the things that are driving it at the moment is sentiment. So sentiment based on the news that is yet to come. So I believe that when that news comes that actually really sees these projects move much quicker towards production phase, that's where it will get the sort of Greatland style boost. But obviously do your own research. I'm not telling anybody to buy or hold the stock, but this is a very interesting stock to watch.
I think another point there is just with all the cash raising, it's always nice to see the share price still going up, so it's absorbed the extra stock.
Yeah, I think when you get warrant conversions to the size of the conversions that Thor have had, and this happened with Greatland as well, when you can see that it's not just being done in dribs and drabs and there's significant conversions, it gives you the confidence that the company are fully cashed up. So in this respect, and it doesn't sound like a lot of money, and I guess it isn't really, 1.3 million, but to AIM sort of minnow miners, that is enough money to keep them going till 2019 on current project basis. Now, obviously, if they're to take on a new project in the Pilbara, which is near-term gold production, one can imagine they will be throwing cash at it. How much, yet to be seen. We know they've got 125k that's already been used in that regard. So, distressed assets are going very cheap in Australia, as we've seen recently with other acquisitions. So, I think it's quite a juicy stock to watch, really. Quite a juicy stock to be in at the moment.
I like the CEO, well, Mick Billing. He's the man, isn't he? There.
Yeah, he's a very relaxed CEO, very open. He does speak to us quite a lot on Share Talk. Spoke to him on Monday, first time for quite a while. He's very pleased with progress on all fronts. He's actually in the UK next week, so hopefully we may get him on for a video interview next week. It's their AGM in London next Wednesday, I believe, on the 29th. So any current holders, I'd advise try and get down there and speak to him. But if I was going to be a bit more selfish about it, it's another company that we're covering next Friday in Walsall at our event. So I'll forward the link to you, Simon, so you can actually share that with your viewers. But I think that'd be a good opportunity to, have a beer with Mick, have a look at his presentation. I'm sure at least one of the non-exec directors will also be there in Paul Johnson. Paul is the guy who exercised the options to give him the 125k. So, and Paul is very heavily vested in the company himself. So I think that has also helped drive the share price.
Okay, John, thank you very much indeed. Nice story there. Good CEO. All adds up, doesn't it?
Yeah, I was just wondering whether you're going to cover MRS today, Zach.
Well, yeah, people say I didn't actually say anything. Like, look, no hands. I didn't.
You've been very clear. You caused a bit of a storm yesterday, didn't you?
I didn't. It was an automatic retweet. I didn't actually, I didn't actually see what it was. I was just, having a nap, and then I just get this torrent of abuse. I'm not quite sure what happened, but obviously, people want to get angry. Let them get angry. I mean, it's just, I really have no interest and no knowledge of the company whatsoever, apart from the ticker code.
Yeah, it's not a stock we've covered, particularly on Share Talk. Admittedly, it's something we see talked about on social media by a select few quite often.
The lovely people.
Yeah, I wasn't planning on covering it myself. I got to admit, I was just joking. But just in terms of what, obviously, part of Share Talk's job is monitoring what's going on social media and looking at the stories that evolve over social media, whether they come via ourselves or not. And one of the big ones yesterday seemed to be around you, Zach, and your employer's coverage of MRS. So,
unfortunately, not an employer either. So I'm getting hit on all sides. Right. It's literally like just going down a pavement and stepping in something or something falling on your head.
Yeah.
Yes, exactly. Yes, that could be the moral there. But anyway, it's just providing information for the market. I'm sure people like to be informed.
Okay, thank you. Thank you for posting the link, Simon.
Thank you, John.
Thank you, Zach.
I'm going to hide now. Simon?
Zach, sorry, I've been speaking into a muted mic, so I'm sorry. Again, thank you, John, for coming in.
Yeah, they don't work so well.
And any final comments from you, Zach, this morning?
Well, no, that was just quite funny with the Management Resources Solutions. Wonderful company. I'm sure it should be in the FTSE 100 any day now. But I'm going to do my homework on it and find out exactly what it does. And what happened yesterday. But in the meantime, I'm sure we're looking forward to tomorrow's show.
Thank you very much. And yes, thank you everybody for attending. We'll speak to you again in the morning.